You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time to view some volatility. If you're a vol trader, maybe you aspire to be, maybe you like to just sling some VIX or VXX or whatever it might be on the side that involves vol, then guess what? You came to the right place. My name is Mark Longo from the old OptionsInsider.com, as well as, of course, from the network. And you can always just subscribe to this show on whatever platform you like, or get the whole network if you want to go for the full kit and caboodle. You can get that pretty much anywhere as well. Or just grab our mobile app that also has it all baked in there as well. And, of course, however you listen, including live, you can join us live every Friday, noon Central, 1 p.m. Eastern, via the old Mixlers, MIXLR. So if you're at your desk or maybe you're having your lunch and you want to check out some volatility, you want to join us, grab that link. We put it out via all the social media platforms. Set it and forget it. You're good to go. However you listen, make sure you hit us up. Questions, comments, insights, all that fun stuff. We do indeed like to hear from you guys. All right, and joining me on the program today, first off, we got an old friend making his return visit to the old show here, Mr. Bill Valentine of Valentine Ventures. Bill, welcome back to the show, sir.
Thanks, Mark. By old friend, you mean our friendship is old. You're not suggesting I'm old, are you, Mark?
I would never suggest such a thing, sir.
I don't want to get started on the wrong foot.
Far be it from me to suggest such a thing. Hey, really quickly before we get started, a little birdie told me recently, and I just need you to confirm this for me. Is it true that you, sir, went on, some might say, a Gandhi-esque fast of late?
Yes, I went on a 6-day water fast, which doesn't mean no water for 6 days. It means no food for 6 days, just water, a little bit of black coffee in the morning. I did this 4 years ago after reading an article in GQ magazine on an airplane about a guy who had done it. And he went through this process that gets you into ketosis. And ketosis has kind of become a hot word these days, where your body's burned up all of its glucose and glycogen from carbohydrates and starts going into your fat stores to create ketone bodies, which are a survival source of energy that allowed our ancestors for hundreds of thousands of years to be able to go on and kill the ibex or the deer that they needed to eat. So it's a really weird high that you get. You don't get like crazy high, but you get a real surge of energy, and it's super good on your metabolic system to kind of reboot it and kind of purge everything out of your GI tract. Not to be too crude, but I went through it. Very miserable process. The first 3 days are among the the worst 3 days you'll have all year, but the last 3 days give you a pretty good feeling.
6 days, I don't know. That's pretty real. I like to do little mini ones. Like I could do like a day or so, and that's kind of what I'm doing now. It's supposed to be all the data, says, a little caloric restriction is good for the old system. I don't know about 6 days, but hey, more power to you. That's some serious willpower there, sir. That's impressive. And you weren't even doing it. You didn't have to do it for some sort of cause. You just needed to do it for health. So there you go. Even more motivation. All right, we'll get joined by the meatball in a minute, but let's not wait for him. Let's keep on rolling right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. It's time on that show when we like to view the volatility that is and indeed was this week. Like we said, we're recording this and streaming it live noon Central here on September 28th, Friday, of course. And as we're doing this, got a little bit of some mixed topsy-turvy markets going on today. They were in the green this morning. Now they're kind of settling off to kind of mixed, slightly unched to down, but nothing really lighting up the old tape S&P. Pretty much unched on the day, was a little bit up. Now it's pretty much slightly down on the day. Dow and Nasdaq pretty much following the same route, and we're seeing VIX Cash taking a little bit of an inhale today, up about a quarter of a handle, right about 1266. So just enough. I was within spitting distance yesterday, Bill, of my crystal ball prediction, and here we are 24 hours later, and VIX decides to move about a handle. And, it just deprives me of my victory yet again. But no, anything could happen. We still got about 50 minutes left. But, it was looking good until this morning, Bill. And then it robbed me of my victory. I think. It's not done yet, but you never know.
Well, in the words of Maxwell Smart, missed it by that much.
Yeah, it's worse when you're close and then it rips it away from you. I had victory. I had defeat snatched from the jaws of victory, I should say. But we shall see. There's still time. Anything can happen over the course of the next hour or so. We shall see. Meantime, though, as our guest, I'll give you pride of place, sir. What's been lighting up your collective tape in the volatility space this week, sir?
Well, I think there's a couple interesting metrics out there. VVIX is remarkably low. It used to be that an 89 VVIX was never really that low, but it hasn't been that low for much of the last year. I mean, we've only been below 90 a few times. So that obviously tells me that there's not a tremendous amount of outsized demand for VIX options. It looks like the put-call ratio right now is sort of VIX puts at 57,000. Calls at 57 versus 40,000 on the puts. So that's 3-2. That's actually not very hedgy. And that's what I guess my point is. I think there's not a lot of hedginess going on right now, although the term structure futures is still pretty wide, with the front month future being about 12% over spot, second month future being about 19% over spot, and a natural upwardly sloping curve moving left to right, which is the normal situation. So, it seems pretty quiet to me. Skew indices, whether you follow the CBOE Skew or the Nation's Skew Index, those are pretty benign. The Nation's Tail Index, which I like a great deal, is pretty soft at a reading of 16. So all's quiet on the Western front, at least on the volatility land, which is, again, remarkable given, I think, what kinds of things we're going through in Washington, D.C. right now, and with the Fed moving yesterday. It just seems like the markets just don't have their undies in a bunch the way that they normally do in light of what's going on nationally.
Yeah, you're right. A lot of things going on a variety of different fronts, some market-related, some just political storm, I think, related, for lack of a better term. But you're right. It hasn't been, it is kind of interesting to see. We're seeing a VVIX right around an 89 right now. So not exactly lighting up the tape these days. We said before that, it was in over 100 not too long ago, and usually in that around 100 range is getting into the more. It was elevated. Now these days, you're right. It's kind of almost like normal is in the mid 90s to 100, and we get into the 120 and beyond range. That's where things are really rocking and rolling. But right now, yeah, settling into an 89. It used to be for a long time. It was in this kind of nice, reasonable pattern. Maybe you'd agree with this, Bill, that it seemed like 75 was a decent floor for VVIX. If you got down there, things were really pretty quiet. And then 100 was a good upper band to that where, if you got to the triple digits, you knew things were happening. And if you blew through that, oh my goodness, all bets were off. It does seem like we've changed a little bit now, and now we're kind of hovering in a different range. Would you say that used to be the band, Bill, for VVIX for a while?
Yeah, and I think if I had to guess as to why that's the case, it's also why the CBOE skew has just kind of the baseline CBOE skew since they started measuring it has just drifted upward. And the only thing I can attribute that to is the increasing demand for VIX related and S&P related options. I mean, just more people trade options today than did 10 years ago. And so it just seems like there's a slightly higher sensitivity. People go to options faster. That spike we had in February was mind-blowing. The one we had in August 24th of 2015, which again touched 50, was mind-blowing. And I say mind-blowing just because the market didn't move that much. The S&P wasn't moving that much. So it's like there's this tremendous amount of liquidity that can just, whack and take out all the offers on everything having to do with options. And all of a sudden, VIX goes from 13 to 50. And so it just seems like this is a long-winded way of saying, if I had to describe why the sort of the baseline VVIX is higher and why the CBOE skew normal range has elevated, it's just that there's more liquidity, more interest in, and more demand for options on VIX and S&P.
I do believe we are joined now by the greasy meatball himself, Mr. Mark Sebastian. Mr. Meatball, welcome to Volatility Views. Better late than never, sir.
Yeah, I apologize for that. I was on a sales call for Carmeline Capital, and it ran long. It was a good sales call, though.
You were in Costco. You can submit it to us. You were buying beans in Costco again. Boy, what a day! Not a good day to be Elon Musk. I don't know what you're talking about, sir.
What I would say is interesting is, this morning it kind of looked like all hands on deck. Vol was pretty high. VVIX was up, 4 points. Today we're seeing VVIX off. It's back to 88. VIX still right around 12.5. And I thought I heard a CBOE skew reference there as I was coming off. And, my argument was, that's back to 140 after having been extremely expensive as of late. I think an interesting thing about Skew Index. This is what I explained to someone that they're like, how can Skew Index be bullish when I thought vol going up is bearish, and I said, well, VIX going up kind of represents more at the money volatility. It represents kind of that near dated stuff that's at the money. Skew is just crash protection, waking up tomorrow and the world is way lower, when I think that there's an imminent sell-off about to happen, I dig into at-the-money stuff. When I'm just like, just in case, that's when I buy way out of the money stuff. So that is my big jump that I make. That's kind of how I elicit the difference between skew and VIX. So when I see skew index getting higher, it makes me want to buy calls, not puts.
Yeah, we actually have a good poll going on right now. I guess we can get to it now since we're talking skew all over the place. We have a good question. I'd be curious to get your guys' thoughts. We actually crunched the numbers yesterday on TWIFO. So those people who listened to TWIFO yesterday, they got an advanced peek at the answer. But our question this week was, a lot of people were getting alarmed when you had those, I think it was like 4+ days of the skew index, getting above 150 and staying there. That was a record period for that length of time. Of course, CBOE Skew Index, we talked about it before, has this kind of somewhat obscure dissemination quotation system where it's multiples over 100, get up to 150, starts getting pretty rich. Of course, that's measuring the skew out there in the SPX. But every index kind of has its own skew narrative that it wants to tell. So we thought we'd ask you guys. Which index do you think has the steepest skew? And now by steep, of course, we mean richness to the 25 delta puts over the 25 delta calls, so that, your old proverbial 50 delta risk reversal out there. It's interesting. I had some interesting thoughts, and it kind of, I'm going to hint that it kind of went the way I was thinking, but there are some wild cards to this, which is kind of interesting. Bill, as our guest, I'll give you first pick. Which index do you think has the steepest skew right now? Russell 2000, S&P 500, or the Nasdaq, sir?
Russell 2000.
Interesting. Why is that? Just small cap, more put love or call hate in small cap right now?
The small cap index for the last 10 years has just been on a tear. I mean, it's the biggest and the best performing broad index globally, the Russell 2000. So, but I don't follow it. I mean, I hope that people are hedging their small cap. I hope they're hedging the small cap because it's just been smoking. And small cap will lead on the downside. Does that mean the downside's coming anytime soon? I don't know. The skew thing, the CBOE skew versus the nation's index, skew index is an interesting argument, right? Because the skew index thing basically says, there's not a particular amount of hedging going on. Their tail index says the same thing. But, like Mark said a few days ago, CBOE skew is at 160. So it's like, are people really hedging or are they not? And if they are, is it meaningful? The other point is that just because it would be implied that there's a lot of hedging going on, that doesn't necessarily mean there's a tail event in the future. I mean, there's no relationship between traders anticipating a tail event and the resulting tail event. There's a huge relationship between a tail event and people reacting after the fact and buying tail insurance. But traders bidding up skew doesn't have anything to do with a future tail event.
No, you're right. That's one of the problems with the skew index is that it's just one number. And it's hard to convey all the moving parts of a thing like skew, which clearly has two moving parts, the put wing and the call wing, with just one number of 150. What does that mean? Are the puts rich? Are the calls cheap? Is it both? So that's kind of hard. That's why I like to use the metrics we have from our buddies over there at Quick Strike, because they actually look at both wings independently, so you could see which one is doing what and what's driving that result. We crunched the numbers. I have the answer. But first, I want to get the Meatball's guess. Mr. Meatball, which of those three do you think is richer to the puts right now than the calls?
Well, it's not the I think NDX vol, VXN is 17 while VIX is 12. That is a crazy spread. So I'm going to go out and say it's not usually high vol elicits a lower skew. RVX, which is the Russell VIX, that's, it's like a little elevated, but not really. It's 1470, probably too cheap. I'm going to go out and say it's the S&P, and that's where skew is at its most expensive is within the S&P.
I was kind of with you, but I was curious about Nasdaq because it is the wild card. It has been very volatile of late, and I was kind of curious what impact that would have on the skew. So I was kind of hesitantly going to guess Nasdaq just because of that level, and it turns out that is the case. Now, the caveat being this is data from a lot of the listed products on CME. Obviously, you could look at a bunch of different ways. You can look at SPX, you can look at SPY. All the skews are going to relatively line up. Might be little minute differences in different products based on the flow there, but they're not going to be dramatic. So you look at a couple of the big ones like the E-mini we looked at on the CME and others. That's where we kind of pulled a lot of this quick skew data, and it actually is kind of a tale of two different skews. We're talking like near term, like front month kind of skew, which is kind of where a lot of the action is in the indices because the weeklies in the front month kind of dominate the flow. When you're looking at that in particular, then it is Nasdaq by a decent margin in terms of heavier to the puts. When you get a little bit farther out, you get into that 3 month, 6 month and beyond kind of territory, then you start looking at S&P. And I think that makes sense because that's still where a lot of the big institutional hedging is going on, and that's bidding up the puts out there. So it's a little bit of a tale of two cities, but the net answer to our question is really Nasdaq, which I was suspecting, but I wasn't entirely sure until I looked at the data. Our audience is actually on board with you, Bill. Our audience says Russell 2000, 39% right now, 35% for Nasdaq, only 26% for the S&P. So a lot of love for other in this poll here this week, which is kind of interesting. That's why I like this kind of data because you look at something like the skew index and you kind of stroke your chin and say, and that's really I think to me the best use case for the skew index. It gets to the point where you should say, maybe I should dig into this further and see what's going on. In and of itself, it's not a thing to make you want to run out and start saying, oh, the world's hedging or vice versa, because you don't really know that just from that number. But still, interesting stuff. Speaking of interesting stuff, Bill, I know you've been cranking away at some research on some on an age-old, long-standing question/debate we've had here many times over the multiple years of volatility views. It's a question we still get a little bit to this day, which is which is the most effective quote-unquote hedge, the long VIX call or the long, take your pick, SPX, SPY, put out there. I know you've been kind of looking at some numbers on this. First off, what prompted you to get back into this area of research? And then B, what are some of the interesting findings you've had so far?
Oh, I'm always looking at ways to hedge tail risk, and I'm not so much concerned about a run-of-the-mill bear market, 20 to 30% year to year and a half, peak to trough kind of thing, which people forget. That's the norm. I mean, the normal bear market is about a 30 to 35% correction that takes about a year and a half to manifest, and then you go on and recover. I'm concerned about a replay of what we had 10 years ago, what we had between 2000 and 2002. 73 to 75. That's what my primary concern is in running a tail risk fund. That is what I consider a tail event. I don't consider bear market a tail event. So I'm constantly playing around with different instruments to hedge within one of my two funds. And so, yeah, the VIX, long VIX call versus long, let's call it S&P puts is an interesting question. The data that I shared with you is data that I think I've talked about on this show before. It's just the remarkable lack of profitability from going long almost any of those instruments by delta. I think it's stunning, for example, that if you buy a 40 delta VIX call, roll it every 30 days over the last 5 years, you've been profitable less than 8% of the time, and theoretically, for those that don't follow this very closely, a 40 delta option should theoretically be in the money 40% of the time. So to be in the money 8% of the time just speaks to the premium that VIX calls are afforded, and that's because the amount of compensation that somebody who's going to sell you that call demands, and that's that steep term structure that everybody talks about as contango, quote unquote. Even in the bear market of 2007, 2009, that same buy a 40 delta VIX call all the way through the bear market, you're still only you would have been still only profitable about 17% of the time. Again, it's just that's where all that reward and all that juice comes from to the sellers of vol that you hear so much about. So I think that's interesting. I think the other thing that's really interesting is that whether you owned long calls on VIX or you own long puts on the S&P, whether it's the SPDR, the SPY or the SPX, if you were short dated in your buying through the bear market of 2007 to 2009, you didn't do very well. If you would have asked me before I started doing this research, hey, Bill, if I bought the 10 delta SPY put all the way through the bear market, how often would I have been profitable and how much money would I have made? You basically made no money. You were only right 8% of the time. So, that wasn't exactly a very good tail hedge. You had to be long dated before the crises began. You wanted to be out 180 to 360 days on whether it's VIX calls or SPX puts. And only in that situation did you get rewarded for buying that protection. So that's a lot. I'm sorry.
No, that's what we like here. It's kind of funny. What I've always heard from these different various permutations of similar studies is and why I've always kind of leaned on the direct put route, because that's more of a direct hedge. The VIX call, I don't really look at that as a hedge. I look at that as kind of like a flyer. And all the data I've seen kind of over time kind of breaks down to, the whatever it is, SPY put, SPX put, whatever it might be. You have your delta there. You know what you're going to get from a hedge. And usually that will outperform the VIX call in a lot of different scenarios until you get those dramatic moments, right? That's where the VIX call really kicks in and kind of outperforms anything else. When the market's melting down, this past February, whatever it might be, that's when VIX dramatically outperforms to the upside. And when you factor in those moments, that's when the VIX call actually, over time can win. But then, of course, that implies you have to have table stakes. Like you mentioned, you have to be in at the game ahead of time. You have to know when those events are coming or continue to roll these positions over time. And that's where it gets very costly. So, yeah, that's kind of, and I've seen a lot of people do different permutations to try to get around that. Some type people doing, upside VIX calendars as a way to kind of pay for the table stakes until you get that big moment. There's all different studies I've seen trying to find ways to make the VIX call more competitive in the normal periods than outside of that. But would you concur with that? That, that's kind of what the VIX game is all about, is being in there. It's kind of like the blackjack table. You want to be in there for 21, and you got to keep biding your time until you have that great hand. VIX call, kind of something similar. You want to be in there until you win it. But other than that, 9 times out of 10, the more direct hedge is the more favorable approach. Would you concur with that?
So there's two other issues real quick. One of which is, you're right. You're absolutely right. In a true crisis, and this isn't like the slow death where the market goes down 50% over 2.5 years, but we're somewhere along the way you have a massive, a couple of days where it just gets clobbered. In that environment, there ain't quite nothing like a VIX call, right? But there's two important footnotes. Number one is you got to be able to sell it, because the VIX call that's up one day, that's up like 3,000%. Could be up half of that 2 days later, because it can come down so fast. And the other thing that you have to know, and this is just something I know from experience, is that the spreads explode. The market makers in a crash who are trading, VIX options for a living, will widen that son of a gun out so far that your gain might be plus or minus $3. The spread can be that wide in the crisis because the market maker is not willing to just step up. And, again, this is a European settled option, so you can't immediately hedge it against something that's going to expire tomorrow, right? So that's a really, really important thing to note. The other thing is that, again, going back to that prior example, where S&P does better than VIX in a bear market, and a significant bear market is one that's absent volatility, right? So yes, generally, as a rule, in a big enough and bad enough scenario, financial crisis replay, you can get more juice out of being long a VIX call had you bought it well enough in advance to where the premium was still small. But the market can also bleed itself to death with low volatility, like it did 73 to 75, where you had very little spikage. And then in that case, having been long a long-dated SPX put would have actually been the better bet, because you just didn't get the juice out of a spike that a VIX call demands.
Yeah, that's why I call it a debate, because it is kind of a ongoing conversation, and I always see new people taking tilts at it and see new data and new ways to kind of, because at either end, the put or the call is still kind of a table stakes game. You want to have it when you need it, when it's most applicable, but otherwise maybe paying for that all the time is not the best way to go. So all sorts of crazy strategies have sprung up as ways to do just that. I think this is an interesting conversation that will continue. Mark, I know we've had this conversation a bit before. Have your thoughts evolved at all on this ongoing VIX call versus S&P downside put debate, sir? And what about that notion Bill brought up, which is a good one as well? I think that everyone talks about the VIX call in the crisis, but when things are crazy, maybe you're not going to get what you want just because of the spreads.
Yeah, and so my argument is, have a system and I mean this, have something in place where you have a system to start buying stuff in more of a static hedges long term are losers. They are. Okay? They do not add value, in my opinion. But if you've got a system where, only when I see these type of things do I start to step in. I was just on a call. He looks at, all of these, Schiller valuation. He looks at stock valuations. Me, I look at the VIX curve. Bill's got his own reason to go long or short vol, and that is, in my opinion, the way to actually execute hedges. I just don't think static hedges pay for themselves, and I have yet to see any evidence that is that anybody has been able to show that at any given point, dating back 50 years.
Speaking of static hedges, really quickly before we roll on here, obviously, before we get to the mothership VIX options, a lot of people were hitting us up, including Pat Hennessy here, about this, what he termed a monster hedge out there. I think a hedge could be in quotes on that because it's debatable what this was actually up to. But out in the S this week, the SPX, of course, it was October 31st, so the end of month there, 2475, 2400 put spread. It was about 70 to 75,000 times people were buying that for 45 cents. It sparked all sorts of conversation about what the hell this guy was actually up to, if 15 to 17% drop can even qualify as a hedge at this point. What else this guy might have had on? We had the conversation, I think, with Andrew. I had a chance to chime in on it earlier this week on Option Block. But I'm curious, Bill, you like your downside puts in the S. Did you notice this spread going up? And B, what are your thoughts on a shall we say 15% out of the money put as a hedge for anything?
So I didn't notice it at the time. I'm a fan of Pat's on Twitter, and people like that providing a valuable service. In fact, if you're trading volatility, you really need to spend a little bit of time just sort of tracking, I don't know, the 20 or 25 people that regularly post on Twitter. I learned a ton of stuff there, even though I do this professionally for a living. There's great stuff that people like Pat put forth. So no, I did not see it. And I'm sorry, Mark, what was the second part of the question having to do with the 15 to 17% sell-off?
I'm just saying, like, if you had any thoughts on what that could be useful for as the hedge against anything. You know, obviously he's got something else on the other side, and if this you would even view this as a hedge.
Yeah, it's always interesting because with all due respect to the financial press, especially the handful of people that follow volatility and options are always writing about, well, the big elephant took on this, or the big whale did this, or 50 Cent did that. You never know what's on the other side of that thing. And so to draw conclusions that, like, this guy lost his ass, pardon the expression.
No, he didn't.
Like, no, he didn't. Probably not. This could be a massive global bank that had a massive position on the other side that was up 4x, and we didn't see it because we don't have perfect information. Yeah,
Mark, these little out of the money put spreads, things like that. Like right now, I've got I'm looking at this morning. This morning, customer bought 25,000 the October 5th, 22.5 puts in the S&P. So does that mean that this guy's like, a crash is imminent?
Yes, no. That's exactly what that means. There's no other interpretation, sir.
That doesn't mean that. It doesn't mean anything like that. It might be like, hey, I've got a weak spot in my portfolio where, if we get a major sell-off, I've got this problem or that problem. It could be closing. It could be opening. You never know how these fit into their great portfolio. I can tell you this. Somebody buying 75,000, 2475, 2400 put spreads has something else on against it. They're not just taking a bet. And it might not be like a market hedge. It could be some sort of vol hedge. It could be something done versus something over the counter. That type of trade smells like some sort of over the counter product got sold and they're hedging off the risk. So, a lot of people don't realize the listed market is, what would you say? The listed market is what percent relative to the over the counter market when it comes to options and derivatives that are traded on a daily basis?
That's a good question. I haven't thought about broken down in percentages.
My understanding is 10 to 20%.
Yeah, it's somewhere. I think it's somewhere around that 20%. I would maybe higher, but yeah, somewhere in that range. Yeah.
Yeah. So, you're looking at all this stuff. Oh, look at all this TV. All the big stuff happens over the counter. All these huge variance swaps. These structured products. You should see the structured products that they come up with in Japan and Korea. It is amazing the type of things. I got a call one time on a structured product around Apple, and it by the time it was done, it turned into like a long put spread, then a short put spread, then a short put spread, then a long put spread, then a short put, and then on the downside, then a long call, short call, long call. It was like just the most ridiculous thing I'd ever seen, and it got sold for size as well. It's amazing the type of structured products that can be built.
Yeah, people don't really have that perception of how much goes up OTC, and you're out of it is swaps and these structured products that fall on the peripheries, the boundaries of what people traditionally consider to be a derivative, but they still count. And you're right. I want to give you guys a chance to chime in on this one as well, because a lot of people are asking. I didn't want you guys to be left out of the downside S&P fund. Let's go on. Speaking of fun, we got to get to the VIX options. It's almost 40 minutes in. We haven't even gotten to it yet. Let's see. An interesting week, and not a lighting up the tape week out here in VIX options land. ADV hovering right around 450,000 contracts right now, so slightly down from what it has been, but nothing huge on that front. Thursday, 309,000 contracts on the tape. Wednesday, a little over 500,000, 541,000 on the tape. 259,000. 259K, I should say, on Tuesday, 281,000 on Monday, and the call to put is pretty much exactly where it has been for all of you watchers of such things, 2.8 to 1. The same as pretty much last week out here. Today on the tape, we got about 115,000 contracts on the tape, so it doesn't seem like we're going to be lighting it up anytime soon here today. In terms of the top VIX strikes, once again, our old friend out there with this risk reversal is running the tape. He's dominating the flow out there. The OC 13 put number one with nearly 500,000 contracts open, 482,000 contracts, taking our number one spot. Number two, the Nove 20s, and then part of that vertical he had on, remember, was the Nove 2026. The Nove 20s, 330,000. The Nove 26s, 224,000. Then we get outside of that a little bit. OC 25s, 213,000 for number four. OC 21s, number five, 212,000 contracts. Number six, our second put, the OC 12 put. Don't like 13? Go down to 12. To 190,000 contracts open there. Number seven, our old friends, the ever reliable DEES 47 halves, 169,000 open there. Number eight, the OC 18s, 164,000. Number nine, the OC 17s, 142,000. Rounding out our top 10 with the Nove 13 puts. So the 13 put strike is kind of getting to be like the 30 call strike. Which actually we don't have the 30s in here. For this is the first time in some time I don't see the 30s on our top 10, which is kind of maybe then who knows? Maybe the 13 put strike is the new 30 call strike. Got to have it regardless of month. Got to have it regardless of where VIX is trading. 138,000 of those bad boys on the tape right now. A total of about 7.7 million contracts outstanding. About 5.7 on the calls and about 2 million open on the puts. In terms of action this week, not a heck of a lot lighting it up. Yesterday, we saw some interesting stuff. Looks like one of the bigger trades hitting the tape was a Nove OC 22. Could have been a bit of a roll maybe, or just a calendar going up 10,000 times, so it's about 50 cents. Looks like paper probably selling the OC, buying the Nove, so maybe rolling, keeping the 22s alive for another month. We also saw kind of funkiness out here. I guess you can call it a Nove Jan. What was this? Looks like a bit of a vertical here. Nove 24s, Jan 24 also spread going up on a bit of a ratio. 60 cents on the Nove. Looks like probably hitting the bid on those, so probably sell them. And 95 cents also the bid on the calls. So maybe a bit of a time stupid. We shall see. Executions are always a little bit funky out here in VIX land, but they did it for size on the day. Total of about 12,000 in the Jan, about 18,000 on the Nove. So a bit of a ratio there. Also worth noting there's decent OI on both strikes, so it wasn't. It's hard to tell if that was closing or indeed opening. Also weird stuff out here. OC Jan DEES 30. I guess you can call it a time fly maybe. 2,500 of the Jan 30s, 2,500 of the OC 30s for 61 cents, 15 cents respectively, against 5,000 of the DEES 30s for 53 cents. So maybe a funky time fly out there going up as well. So all sorts of kind of weird paper. Nothing really lighting it up for craziness that we saw. I don't know, Mr. Meatball, what was coming across your tape out here in VIX land this week?
I saw a lot of kind of back and forth in most of the trades. We had some customers coming in and selling upside calls in October. There was a big seller of the 15-20 call spread. And then we also saw a lot of kind of way out of the money stuff getting bought. Again, kind of just some hedge, some kind of crash protection type stuff. Saw some DEES call buyers and some November call buyers, kind of way out of the money though. So that's kind of the bulk of what I bought. There was a decent kind of VXX spread that I saw. A customer wanted to sell the October, what was it? They wanted to sell the October 55s, buy the November 60s, and they paid a nickel, and they did that 10,000 times. I thought that was interesting. But yeah, the type of stuff we're seeing, along with kind of your skew index idea, I'm not seeing kind of the at the money and near the money type of VIX purchases. I'm seeing a lot of out of the money. And then I'm also, and at the money, there are a lot of people that are willing to sell premium. And that is usually, and which is why VVIX is 89. I'll be interested to see if kind of whether this kind of low VVIX and lack of an at the money appetite points toward a nice little bull run into earnings season over the next 2 weeks.
Bill, same question for you. Anything in the VIX tape catching your eye this week, sir? Bill, maybe the Skype gods have lost you. Bill, are you there, sir? I'll have to reconnect there with Mr. Bill. All right, let's keep on rolling. Oh, did I get you? I don't know. Looks like we can't. We'll see if I can get him back for us here, listeners, as we keep on rolling here. Mr. Bill, do we have you there, sir? Are you there?
Can you hear me now?
There we go. All right.
Can you hear me now?
All right.
I was agreeing. I was tipping my hat to Mark Sebastian. I mean, I didn't appreciate this, but he's absolutely right. I mean, you've got the November 12.5 VIX calls. VIX is about 12.5 today. You got 127 open interest contracts. That's just 127. As opposed to the 20s that have 330,000 contracts, or the 26s which have 224. I'm always interested. I spend a fair amount of time with looking at what other people do. Yeah, and so I see weird stuff and I always just wondered about this. And I'm just saying this to be silly, but so there's one open contract on the November 70 VIX puts. Like, why do you put that on? Get a futures account and own the November future.
Are you making fun of my Nov 70 put, sir? What's wrong with you? I needed a one lot. It was there. I hit the bid. It was great.
Hitting too close to home. So sorry to my host. No, I mean, just stuff like that's kind of weird to me. What's the thinking behind that kind of stuff? But there's just so much robust demand for this is really to the credit of the CBOE. Despite the lack of profitability of being long any VIX, call it any strike or any delta, it's insurance, right? And you assume you're going to lose your premium on most forms of insurance, but no, it's an interesting quiet market right now. With the term structure being the way it is, I was just looking at this. To buy the November 16 calls, you pay $1.60. So you're at $17.60 before you start making money on a VIX level currently at 12.4. Does that mean it can't blow through 17 on its way to 40? No, of course not. But boy, that's an expensive piece of insurance. And that's, by the way, that's the 50 delta VIX call for November. So to be the 50 delta VIX call, to have to get to 17 and change from 12, like, wow, but somebody's doing it. There's 80,000 contracts that have already traded that way.
Yeah, I think it's probably a whole show to be done, and we've touched this in the past, just in the crazy extremities of the VIX wings and what's going on up there, because there's all sorts of madness afoot. Usually it's in February we see the crazy upside, the 70 calls. Not quite the 70 puts too often. Maybe some of those flooding in, but maybe there's a show to be done there, I think, as well. Just the weeds of VIX sometimes. Let's instead move on to our old friend, because we're coming up against it. VXX almost unched from last show, about 2660 or so in that range right now. So pretty much unched. ADV close to what it was last week as well, about 222,000 contracts. 2 days over the ADV, Thursday and Monday, with 223,000 and 226,000 respectively out here in VXX land. Seeing some stuff lighting up the tape out here in VXX even today, which is kind of interesting. And it shows again why we have a market. What makes a market, right? Is people expressing all sorts of interesting, diverging, perhaps, views. Like one of the big print in VXX options today, someone taking yet another flyer on near-term downside, the OCT23 puts. These are, I think, the weekly, so they're going out on the 5th. Yeah, 20,000 of those going up today. Someone gobbling them up for a nice penny. So taking a little bit of a flyer here on the downside. That's all opening, by the way. At the same time today, the number 2 trade we see looks like a size buying vertical in the call side in VXX. The Nove 3650, almost 17,000 times. Paper buying that for looks like about 60 odd cents. Again, that's all opening as well. And that's not enough for you. A little bit longer term. Looks like we got a bullish time risk reversal. Let that one soak in a little bit. The D22 puts versus the Jan 35 calls. Paper doing that 10,000 times today for about $1.40. It looks like $1.43 or so. Looks like selling the puts, buying the calls. So all sorts of things all over the place, Mr. Meatball, today in VXX. You want to take a flyer on downside? They got you covered. If you want to take flyers on near term or perhaps even longer term upside, got you covered there as well. Kind of interesting stuff. You know, it's interesting to see some of the longer term VXX stuff because you hear the talk about the midterms. You don't hear a lot about talk about drivers of vol into like January, you know?
No, you don't. And yeah, there's some really just kind of weird stuff going in and out. Yeah, there's in VXX. Have you heard? You know what actually is the highest open interest option in VXX though?
I'm going to go out on a limb, and I'm going to say it's potentially the Jan 10 put, which I keep acquiring en masse.
It is the Jan 10 put. Indeed, it is the Jan 10 put, which are no bid at 2 now. They've gotten...
Ooh, at 2.
1-2. 1-2.
1-2.
I'm up 50% on my puts. Woo!
Party time in Carmen Line.
So there is... Yeah, I mean, think about this. There's 15,000 open interest in the Jan hundreds. So there's all kinds of VXX is a weird animal. I feel like a lot of the hedging that goes on in that one is maybe a little less sophisticated than some of the VIX stuff. It just, you know, like today, the no 50 calls have traded 17,000 times already. Did you know that? Actually, it was a 36-50 call spread went up 17,000 times.
It's the vertical I just explained.
Yeah, there was buyers.
16,000 times.
17,000.
It's okay if you ignore me on the show, sir. It's all right. It's all right.
I did. But I'm just kind of going through everything. There's that trade, and then that's about it. Not a lot of really exciting stuff, you know, other than, like you said, your flyer puts and things like that. But I don't know, just kind of a funky day today.
Yeah, it is a weird one. I would kind of concur with you not to besmirch people who trade VXX, and people certainly do it, and they're very sophisticated at it. But it does seem like, as a whole, in aggregate, a little bit less sophisticated paper we see than, you know, you don't see the crazy, you know, 1x3x8 crazy structured nonsense that goes up all mid-market and VIX all day long. You know, you don't see a lot of that in VXX. Bill, anything lighten up? I know you like yourself a little bit of VXX. Anything lighten up your tape out there? You slinging anything in VXX these days?
Well, I'm actually a huge fan of VXX options. I think they're great because you can arbitrage against an underlying, so it keeps the bid and ask real tight. There's a tremendous amount of volume. It's to the credit of the VXX. I mean, I'm looking at November's everything from 20 higher in the calls has got open interest. So they're a super liquid way of playing. If you don't want to play in VIX, and VIX is, you know, probably 1 degree of complexity above the VXX. For people who are retail traders, so naturally they gravitate to the VXX. It's easier to understand, it's easier to follow. But I use them. I mean, I'm the one Mark called out. I'll be the first one to tell you I'm long the November 50s as a hedge, and I just think that it's really the only ETP option market that I'd ever trade in. It's the only one that really has a sufficient liquidity. When VVXY decided to change its stripes and its underlying strategy, I mean, I forget. The UVXY options are dead to me. You know, I would never do that again. I won't ever trade the SVXY options again. They're dead to me too because you can't change your strategy. I got stuck holding some stuff that got, you know, the Option Clearing Corporation didn't adjust when they changed their leverage on both of those funds, and so I'm forever spurned and away from those two. And the only ETBs I'll ever trade options in are the VXX.
Yeah, you're certainly not alone. We've seen a lot of that anecdotally from our audience as well. You know, SVXY and these other products, a lot of them are dead to them as well. So, in many odd ways, the VIX-ocalypse of February was one of the best things that ever happened to VXX because it's a survivor. It survived, and so as a result, a lot of business heading its way that maybe wouldn't have otherwise. Let's get to it really quickly. Let's get to some questions here. It is time to check out our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Vol voicemail. A lot of stuff hitting the tape. Oh, the Flowmaster's floating around listening right now. He's chiming in our live chat. He says about the VXX Jan 10 put show from a year ago. We talked about him a year ago. Maybe we did. I think that might have been the show, Mark, where you and I discovered them because we were kind of mocking them, and then in the middle of mocking them, we kind of started stroking our chins and said, maybe these aren't as mockable as we initially thought. I need to go, you're right. It was a year ago. That was that long ago. Wow, crazy. He's also talking about a notable put right on, what does he got here? I don't have the strikes here, but it looks like he's talking about VXX. I'll have to see here. Oh, Stadini saying he loves the show, but he likes it so much it's hard for him to concentrate in his position, so he has to tune out. I got you. Sometimes we're too distracting even for our own good here on the show. Here's a question that's right up what you were just talking about here, Bill. This is Leans. Leans wants to know, do you think SVXY will ever go back to its pre-Feb structure? I'm gonna go out on a limb and say no, but since you've washed your hands of it, Bill, I'm gonna go out on a limb and think you agree with me.
No, absolutely not. They did it to protect them, to stay alive, right? I mean, they had a near-death experience in February, and why would they, right? Why would they go back to 2x leverage? You know, that's not to say that somebody won't reintroduce another 2x. 1x leverage on the 30-day, the long 30-day future. But, as we saw, the shenanigans that happened in that 15 minutes after the close, the SVXY dodged a bullet, and they'll probably never go back. And for the same reason, the UVXY probably doesn't ever go back to a 2x leverage on the 30-day. But my issue was you can't change midstream. And again, I'm spurned. I owned a UVXY 5 delta call during the crisis in February. Saved my bacon. It was wonderful. I rolled it forward. UVXY changed its leverage. It went from a 5 delta call to about a 1 delta call, and they didn't adjust them. So it's like, I don't like those products. I wouldn't mind if they went away. I think between VXX, VXZ, ZIV, those are about the only 3 ETPs we're paying attention to. But clearly, I've got an axe to grind.
No, but you're right. I think a lot of people were rubbed wrong by the way it was handled. Right? It was just after hours, no warning, no adjustment, no nothing. It's just, hey, all you options players, you're all screwed, and thanks for playing. That kind of thing with any sort of, you just annihilate all the premium in all your products. It's just like,
and then the OCC didn't adjust them, which I
Exactly.
still find unfathomable why they didn't. It makes no sense. This was basically the same as a reverse stock split. You adjust the options.
Right.
You'd think. So there was a lot of drop balls there. Oh, I'm looking here. I see now what Henry wrote. He actually wrote the flow that we analyzed a year ago on the show. What caught our eye, Mark, about those puts was someone wrote 100,000 of these Jan 2019 10 puts for 16 cents, untied back when VXX was 41 and a quarter.
Why haven't they covered for a penny?
And they, the premium collected was 1.6 million. Notional value $412 million. 16 cents they sold those bad boys for. I have to assume that's a good chunk of what's still open out there, which is strange. You got all this capital tied up, take it off the table. I don't understand that at all. But that was what we profiled. Then we started thinking maybe selling them isn't the way to go. I think that was what opened the floodgates to us and to clearly a lot of our listeners. Just loving these crazy VXX puts. Here, let's squeeze in one more here because we've been neglecting our listeners. Tim, the the creatively named Tim. Tim wants to know, a bit of a thought question. Is there really such a thing as a covered call in VIX? Since the options don't expire into futures, if I'm long a future and I sell a VIX call against it, what is that called? Well, this is all sorts of interesting. This could get into all sorts of questions about if you do it in the SPX or other things that are cash settled. Is it not a covered call? It's kind of crazy. I don't know. Who wants to field this? How about
I'll take this.
How about Mark? Go ahead.
This.
I'm sure you'll have a very normal and non-agitated view about this.
So no, all right. So here's the thing to think about is the VIX future is cash settled. The options are cash settled. All right. If you have portfolio margin, they cross margin. They settle at the same time, same day, same process. So if I sell 10 VIX calls against one VIX future, that is a true, about as true as it can possibly be without being 100% technically a covered call. All right. Now, SPX is a little different because there's only 4 futures a year. VIX has a future every single month. So you can I would say that, maybe some technocrat would say that's not technically a covered call. But in all practices, in all forms of reality, that 10 calls versus a future is in fact a covered call. SPX, you have to be a lot more careful because there are serial months and quarterlies. So if I buy a S&P 500 future in, let's see, we're in the December future, and I sell an October call against it, well, guess what? I need to roll or close before October settlement. Otherwise, I'm exposing myself to what we call settlement risk. You do not have settlement risk with VIX futures and VIX calls if they're done at the exact same month. So so basically, yes, there's such a thing as a VIX covered call.
Yes, that is the answer. Well done, sir. Long way around, but you got to cover those bases sometimes with people because there are these nuances in these products that can be sometimes overwhelming to people. Or it can also be overwhelming as a crystal ball. So let's get to it.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball, the portion of the show where we guess wildly about the future of VIX. And Mark, I was looking good yesterday. I was looking so good. And then VIX giveth, VIX taketh away. It took away from me on this little bit of a move here yesterday into today. And now we're at 12:42 coming into the end of the show. You did the able analysis of keeping your pick from the week before, just changing it by 0.01. So that worked out in your favor this week, sir, as you get the closer of the two. My 11.25. I was optimistic, but it was looking good to the downside until not so much. So I'll let you pick. Mark, do you want to go first because you technically won, or do you want to let our guest go first? What do you want to do?
I'll go first. Screw Bill Valentine.
How charitable of you.
Screw Bill Valentine. I will do, what did I guess last week?
12.14.
I'm going to guess 12.15.
How did I know you would go exactly back to what you were for the last 2 weeks before that? This is the kind of in-depth analysis he's doing here on the show here, Bill. Bill, you got a more nuanced view of VIX for us, sir?
I have a less nuanced. I'll punt and take the mode. I always do. It's 13. I'm never on 2 successive week marks. I've probably been right a number of times. I'm probably owed some prizes. You probably had some prizes sitting around your studio that should have come to me when I was right.
You're the closet winner. You are the closet winner every year of our crystal ball contest.
I'll stick with 13.
13. Okay. Yeah. If you ever make your way to Chicago again, you can feel free to raid our adult beverage stock that Mr. Meatball always drains when he's here.
Thank you.
We have that.
That'll be fun.
We probably have some good things in the Options Insider Vault. We could load you up with some, make you look respectable out there when you're amongst your peers. All right, so we got a 12.15 and we got a 13. So we got a lot of handles higher. That paves a way for a lot of downside for me here. I'm not going to be quite as pessimistic on the vol front as I was last week, even though it was looking good until it wasn't. So I'm gonna go a little bit north of where I was. I'm gonna say I'm still gonna be an 11 handle. I'm gonna keep that theme alive. I'm gonna say 11.75. 11.75. So we got a nice little spread here, listeners. We got 11.75 on the downside. We got Mr. Meatball hanging out where he always is, right around 12.15. And Mr. Valentine on the upside, going for a little bit of 13. He's playing the Russell role on this week's show, the upside VIX buyer. All right. And that music means, unfortunately, we've come to the end of Epic Shit. Didn't have time to even talk about Mr. Musk and all of his craziness. Spoiler alert, Vol's up in Tesla. Stock selling off about 12%. The Vol is up from about 55 or so to about a 70% in the front month. Realize, hovering around 53. It's going to be a little higher. I think we got today's numbers factored in there. Yeah, Vol up. Live by the tweet, die by the tweet, as they like to say, as the SEC. SEC doesn't play. And especially they think they can make some political hay at your expense. Guess what? They're going to come after you. And that's what they're doing with Tesla. So interesting stuff there. Didn't have a chance to get to that, but interesting stuff. Let's go back around the horn. Let's give our guest pride of place. Mr. Bill, what's cooking in your neck of the woods, sir?
Nothing. Just making it through summer. We're selling a house. We're moving into a new house. That's my primary concern in life.
And if people want to stay on top of your musings, is the best way the old Twitter machine, sir?
Yeah, I like the Twitter, at B Valentine CFA. Follow me there. I like the Twitter. B
Valentine CFA. Give the man a follow. He's always tweeting out interesting stuff, data, research, a chat with some of our other guests, putting good stuff out. Check him out, B Valentine CFA, to learn more. And Mr. Meatball, sir, what's cooking in the land of the Carmen line in addition to you doubling down even more on your Jan 10 puts?
We just hired a new CEO, which I'm excited about. He's going to be coming on as one of our new partners. We are, and his job is to basically raise assets, improve efficiencies, make me do my job better. And I'm really excited about it. So welcome aboard, Eric. And if you're looking for a really smart way to trade the S&P and with a hedge over it, you want a smarter version of the S&P 500, one that is using options and VIX to hedge. Reach out to me, Mark at Carmen Line Capital, if you're an accredited investor. So, love to hear from you.
Good choice. Always good to have adult supervision of the meatball out there. So, excellent choice on adding a new CEO to the mix. Check them out, Carmen Line Capital, or indeed, if you want to learn about all this stuff we're talking about here, why is there a VIX covered call and things like that? OptionPit.com is the place to go for such things. And on behalf of the Greasy Meatball and Bill, who is nicknameless, but if we get him on more, maybe we'll have to come up. Maybe I'll start calling him Gandhi for his fasting. I don't know. Perhaps that's offensive, so perhaps we won't go that route. But still, check him out, B Valentine CFA on Twitter. And indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing. All the other fun stuff that you guys do. Keep it up, and we'll see you next week for more Volatility Views.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.